Morning everybody. As Mark mentioned, my name is Richard Wolanski. I'm the Finance Director for Avation. I'm here to introduce you to Avation and its business model. What I hope you've been given is a copy of this presentation. So if anybody doesn't have one, please raise your hand and we'll get one to you. I'm not going to go through every page of the presentation because I've only got 15 minutes. The purpose of what I'm trying to do here today is just give you an introduction to the company, explain our business model and background, also explain how we make money effectively, and then give you a sense so you can go away and have a look at the company in more detail as to what we're going to achieve over the next year and short term, what our prospects for growth are, what our prospects for improving and maintaining our very high profitability are, so that you can make an informed investment decision. What Avation is an aircraft lessor. Now what that means is that we own commercial aircraft and we lease them to airlines, and these are all household airlines that you know the names of. So the best analogy I can give you for our business is that it's like owning property. So we have 27 planes in our fleet today. It's equivalent to owning 27 houses and renting them out to 27 tenants. There are a few dramatic differences between aircraft and property. Aircraft typically yield 5 times what a property investment will yield. That's the number one thing. Now, property lasts forever, so you've got to earn more money while your plane's alive to actually generate real profits. But it's extremely profitable business. The demand for aircraft is growing significantly. And we think our opportunity to grow will be maintained. We've doubled our size and our fleet in the past couple of years, and we expect to do the same over the next couple of years. Our profitability has responded, our revenues have responded, and our share price has responded. And I'll tell you right now, our share price has doubled in the past year. But we've got the revenue, profits, dividends, yield to back that up. And the interesting thing, the most important thing that I can impart on you today is that we're about to grow faster in the next year than we ever have in the history of the company. So there's plenty of growth in earnings, profits, revenues to come. What we've got, as I said, we've got 27 aircraft in the fleet today. We will be delivering another 9 aircraft before Christmas 2015. We're delivering 4 aircraft before Christmas this year. So lots of growth moving forward. This is a bit of a synopsis of us and what we do. As I said, we're a high growth aircraft leasing company. We're listed on the main board, our code's AVAP, but we're all based in Singapore. We've only got 14 employees. It doesn't take a lot of people to run a business like us. And the reason why we're based in Singapore is that Singapore gives us very advantageous tax rates. The less tax we pay, the more earnings that are available for shareholders. In May, we just announced that the Singaporeans gave us a discounted tax rate. Up until May this year, we were paying corporate tax of 17%. And the results that we announced last week, which are available in my booth, please come to the booth afterwards if you require further explanation. The results in there will show you that we paid $2.5 million tax in 2014. Now, our tax rate from May drops from 17% to 10%. So a huge boost in profitability just by lowering the tax rate. But that's not why you're going to want to buy shares in this company. You're going to want to buy shares in this company because of our growth and because of our underlying profitability. So as I said, we've got 27 aircraft in the fleet. We've got 4 to be delivered before the end of this year and another 5 planes to be delivered in 2015. Beyond that, we have got the right to buy another 27 aircraft to take our fleet all the way above 60 aircraft. We focus on the most popular workhorse type aircraft that every airline uses, because like any tenant, our risk is if an airline goes bust and we have to take our plane back. So what happens then is that we take our plane back and we remarket that plane to other airlines. Do you want to use this plane in your fleet? the easiest planes to remarket with planes that are in highest demand. And we're a bit of a niche player. That plane on the front there is a turboprop propeller plane. We specialise, they make up half our fleet. We've delivered 18 of those in the past 3 years. And as I said, we're going to deliver another 8 just this year alone. Now that particular aircraft is sold out for 3 years. So lots of airlines want that plane. That's why we get such high yields, high rental yields on it. But it's a single aisle aircraft, it's your workhorse. It's not on the front cover of an annual report of a British Airways, but it's the one that does all the work. It flies people out, to the lesser known routes, and every airline uses them. They're really fuel efficient. Those planes use about 1/3 of the fuel per seat per hour than a jet does. Now, if a plane uses less fuel, it makes the airline more money. If it makes the airline more money, they're prepared to pay us a better yield. That's why we specialise in that aircraft. We're trying to grow our fleet aggressively, and we've been successful at that, and we'll continue to do that by accelerating our growth rate over the next year. We've actually added new customers that we're serving. We delivered our 27th plane on Monday, and that was to a Taiwanese airline. Very strong credit risk. They are owned, the airline that we delivered it to, it's this green aircraft here. So that airline is Uni Air. That's owned 100% by Eva Air. Eva Air is one of the world's great airlines, Tier 1 airline. So that's a very profitable plane for us because we know that they're going to be around in 20 years' time. We've only got 52 million shares on issue, and yesterday our share price was £1.60. So our market cap is around about 80 or so million pound. The management of the company, directors and management, including myself, own 22% of the company. We've been buying the stock on market over the past year. We're putting our money where our mouth is. So this is a breakdown of our fleet. There are our list of customers on the right-hand side. So we've got 27 planes that you'll see in the red box there. Then we've got another, you'll see if you look across the page, we're delivering 4 more this year, another 5 next year, and then we've got 27. So you add all of those up, that adds up to be the 60 aircraft that we hope to grow our fleet to in the next sort of few years. And that's just delivering that propeller aircraft. We also own 11 jets, and we can buy jets, and we are looking to buy jets and add jets to the fleet. So when I talk about adding to our fleet by 44%, that's a base case. That's just through the propeller aircraft. That doesn't include any jets that we might buy from airlines or other lessors. And we bought 2 jets last year. So 44% growth to Christmas next year is base case. So the other important thing you've got to look at with companies like us that own aircraft is how old the fleet is and how long the leases have got to run on each aircraft. Now, our fleet age is coming down. Our fleet's getting younger because all the planes that we're delivering are new planes. They're typically delivered with 10-year leases. So the average lease across our whole fleet has still got 6 years to run. But most of the next planes that we're delivering this year will have 10-year leases on them. So effectively, the results that we just delivered that show great profitability, we've guaranteed that for the next 6 years because the leases run for the next sort of 6 years. But then we expand on that by adding new aircraft with longer leases, and we build our profitability out that way. So we've got about $500 million in aircraft assets as we speak. As I said, we've delivered 18 of those turboprop aircraft, and we've got jets as well that we're looking to acquire. We focus on profitability and yield on the asset. In a lot of ways, we're like a finance company. We buy a plane, we use the bank's money to buy that plane, so we're leveraged, and then we get our customers to effectively pay that plane off. And you'll understand this very, very well in that, just like if you own a house, every one of our planes pays off principal and interest each month. So they pay themselves off. So we own all our aircraft, we just borrow money, and then the customers help us pay off that plane, and we own it outright. And that's what our business model is. So we're focused on profitability. You know, the yield that we get on our assets, if you look at our balance sheet that came out last week, we get 15% yield, revenue yield on our balance sheet assets. That's compared to, say, property where you might earn 3%. The cost of our debt, which is also public information, is about 5%. So 15 take 5, we net 10% yield on our assets. These are the results that we brought out last week. So it's 2014 versus 2013. Our year end is 30 June, so that might be a little bit different. So these are actually current information. So we grew our income by 30%, our EBITDA by 30%, our net profit after tax by 30%, and our EPS by 21%. Real solid growth and profitability. The number I want to draw your attention to there is net profit after tax versus total income. Last year, we converted 25 cents in every dollar of revenue to net profit after tax. So it's profit after tax margin of 25%. It's the same this year. So we're growing really fast, but we're not sacrificing profitability. And how many true companies do you know that have really high growth and really high profitability? It's very rare. It's because our business model is sound, aircraft are a great investment, and the yields have remained stable or improving. In that time over the past years, we've lowered our cost of debt. We haven't employed any more people, so we spread the admin cost against more planes. And I've already told you, we've lowered our tax rate. So 2015 is going to be a better year for us. This is the most important thing that I can tell you, this slide. Once you understand this slide, and I'll take a minute with this slide, you'll understand how we make money in this business. That's the 25 to 30 years that a plane might live for. What it says is that we might lease that plane for 3 times over its life. So the leases are all long-term, 10 years, 8 years, that sort of thing. The turboprop aircraft, the list price is about $20 million. On that aircraft, we'd expect to earn 1% a month of what we paid for that aircraft. So $20 million, that's $200,000 a month. Now, if that plane is leased for 12 years, 12 months of the year, the whole time, it'll pay back 144% of what we paid for it in the first lease alone in that 12 years. That's more than enough to pay that plane off. So at this point in time, we own the aircraft outright, and it's still got all this time to live and give us all of that yield. But there's no interest expense anymore. So it actually becomes more profitable, generates lots of cash. What we actually do is we refinance, we extend the lease with the airline. We've done that with 7 of our planes this year, so a third of our fleet. And then we go to the bank and we refinance the plane, like you might remortgage a house. But we use that money that's released to go and buy more planes. And so that's how we've been able to double our size but not actually raise too much money from our shareholders. And if you're not diluting your shareholders, the share price goes up. What's important to note as well, over the life of an aircraft, $20 million aircraft might generate $45 million average, say, of revenue. You've paid $20 million for it, so take that off, take the interest expense off, which might be $6 million. 20 million aircraft is generated, after you do that, 26. But we haven't put in $20 million. We might have only put in $2 million. The rest is debt. So we are highly leveraged. We're leveraged at 75%. But as I said, every plane pays off principal and interest. So just to finalise, the ATR 72 is that turboprop aircraft that we specialise in. It's very popular. We're delivering that plane worldwide. We're adding new customers, and we're diversifying our base of customers. We're also looking to add jets, and we're interested in buying jets that are less than 5 years old. When we buy a second-hand jet, you're not only buying the jet, but you're buying the lease that's attached to it, and so you're getting a customer with it. So we can grow our customer base by buying second-hand jets, and we think we're going to do that this year as well. So the final slide, we're continuing to target aggressive growth. We've got lots of hidden balance sheet value in that the book value of our planes is actually a lot less than the realisable value of our planes. And I'm happy to explain that to you if you'd like to come back to the booth, because I'm running out of time. We've got lots of growth committed in future delivery slots for the aircraft. We're looking to increase our earnings per share, lower our cost of debt, which we've done over the past couple of years. and diversify our risk profile, so there is lots lower risk. We're trading at a PE effectively now of about under 8 times, and our peers in the US who do what we do trade at 14 or 15 times PE. As we get size and scale, we think that we're likely to be re-rated. And the PE doesn't actually take into account the fact that in the last year we grew 30%, and in the next year we're planning to grow our fleet by 44%. So there's plenty of profitability and earnings to come. I'll be outside for the rest of the day. If you need any further explanation, please come along. I'll be happy to explain it in more detail. Thanks very much.